Welcome to Tech Money Madness, your daily U.S. stock market podcast, May 15th, 2026. We are diving into a really wild day. I mean, imagine looking out your window and seeing a Category 5 hurricane actively tearing the roofs off your neighborhood, right? But then the house across the street is just casually throwing a multi-trillion-dollar pool party.
Right. Yeah, it is a completely profound disconnect. I mean, normally a financial ecosystem moves together, at least broadly speaking.
Yeah.
But today, we're witnessing, well, systemic panic on one side of the ledger, just colliding head-on with this localized, entirely unchecked euphoria on the other side.
And that is exactly our mission for this deep dive, because whether you are actively managing a portfolio or, you're just trying to understand where the economy is headed and how it affects your wallet, today's briefing from our sources is just a masterclass in whiplash.
Oh, absolutely. Whiplash is the perfect word for it.
So we're going to cut through the noise of this incredibly turbulent trading day. And the core contradiction we really need to solve here is this. How on earth does a day where the Dow crashes 500 points also feature a company positioning itself for a $4 trillion valuation?
Right. Well, to understand that contradiction, you have to look beneath the surface at the underlying tectonic plates.
Yep.
And right now, the most massive, destructive plate shifting under everything is inflation.
Okay, let's unpack this. Before we look at the specific winners and losers, the rockets and the sinkholes, we need to set the stage with the macroeconomic weather report. And frankly, the sky is incredibly dark today.
Very dark.
The Dow Jones took a 500-point nosedive, and it was directly tied to mounting inflation worries. Meanwhile, the S&P 500 is currently clinging by its fingernails, struggling to hold on to what would have been its 7th weekly gain.
Which, I should add, is a crucial detail. A 7-week winning streak is a sign of deep structural market optimism.
Right.
It means institutional money was flowing freely, assuming the worst of the macro storm was behind us. So when a streak like that gets threatened in a single afternoon, it means a severe reality check just arrived.
Wait, I have to challenge this, though. Markets are supposed to be forward-looking machines, right? We have known inflation was sticky for months. We've all been living with it. The briefing numbers today show April consumer inflation surged to 3.8%, and producer inflation jumped to 6%. And top economic forecasters are projecting inflation will hit 6% in the second quarter and just get worse over the next several months. But it's like a horror movie monster. Just when you thought the monster was dead, you see its fingers twitch.
That's a great way to put it.
But wait. Why wouldn't Wall Street have already priced this in? Are you saying their algorithmic models and thousands of analysts were just entirely blindsided by a jump to 3.8% consumer and 6% producer inflation today?
Well, that is the multi-trillion-dollar question right there.
Yeah.
I mean, the algorithms and the analysts weren't necessarily blind to inflation existing, but they were entirely wrong about its velocity at the factory level.
Yeah, okay.
The key to today's panic isn't the 3.8% consumer price index, the CPI. It's that 6% producer price index, the PPI.
So the cost of doing business behind the scenes.
Exactly that. Think of PPI like the water pressure building deep inside municipal water pipes. You don't see it at your kitchen sink yet.
Right.
Your faucet is the CPI. It's running at a slightly annoying 3.8%. But if the pressure at the hidden reservoir suddenly spikes to 6%, it is a mathematical certainty that your kitchen faucet is going to blast you when you turn it on a few months from now.
Wow. Okay.
So the market didn't panic over today's consumer prices. They panicked because that 6% producer inflation basically guarantees consumer prices will explode tomorrow.
So it's not a mystery, it's just physics. If the factory pays 6% more for raw materials and the supplier pays 6% more for shipping, businesses aren't going to just absorb that out of the goodness of their hearts. Eventually, the consumer is holding the bag.
Exactly. And that realization triggered the ultimate domino effect today, leading straight to the Federal Reserve.
Right. The Fed.
Yeah, the Fed funds futures market, which is essentially where traders place hard bets on what the central bank will do next, it completely inverted today. Based on this new PPI data, they are now pricing in a Fed rate hike as soon as December.
A hike, not a pause, not a cut. We are actually back to talking about raising interest rates.
Yes. And the bond markets are backing that up. They're pricing in a greater than 50% probability of a hike by year end.
That's wild.
It's a massive psychological shock. I mean, the market had conditioned itself to believe the era of rate hikes was in the rearview mirror. But our sources note that the outgoing Fed governor, Stephen Barron, recently shared some big ideas with the incoming chair, Kevin Warsh.
Right, the transition.
Yeah, and the implication of their transition, when you combine it impartially with this hot inflation data, it has entirely shifted the ground rules.
Let's break down the mechanics of that shift for a second. Why does an unexpected rate hike in December suddenly drain 500 points out of the Dow today?
Well, it really comes down to the cost of capital and risk assessment. When interest rates go up, borrowing money becomes more expensive for corporations.
Right, their debt gets heavier.
Exactly.
Yeah.
And that immediately shrinks their future profit margins. Simultaneously, safe investments like U.S. Treasury bonds start offering higher guaranteed returns.
So why risk it in stocks?
Right. If you're an investor, why would you risk your capital in a volatile stock market when you can get a guaranteed high yield from a government bond? Higher rates pull money directly and aggressively out of equities.
Okay, so that's the heavy, suffocating macroeconomic storm currently battering the neighborhood. But I want to pivot to the house throwing the pool party, because if the macro environment is this massive, oppressive hurricane, the tech and AI sector is just a rocket actively trying to launch right through the eye of it.
Yeah, they are attempting to completely defy macroeconomic gravity right now.
But they aren't totally immune to the weather. The briefing points out that the broader AI-driven market rally is actually facing some friction from this inflation surge. And geopolitics threw a wrench in the gears today, too.
They certainly did.
We saw the broader semiconductor sector decline because the summit between President Trump and President Xi concluded without any major chip agreements, no big diplomatic breakthroughs for the tech supply chain at all.
Which honestly is a very logical market reaction. Geopolitical standoffs over semiconductors, which are, the literal physical brains of the AI revolution, create a massive cloud of uncertainty.
Right.
When heads of state meet and fail to produce a clear framework for tariffs or global strategic alignment, sector indices that track the broad industry inevitably drop.
But here is where it gets really interesting. Here's the contradiction within the contradiction. You would assume a failed summit would tank everyone involved in Chinese trade. But NVDA actually gained today
Yes, they did.
on news of Chinese approvals for their H200 chips. How does the overall semiconductor sector drop due to a lack of a diplomatic agreement, while NVIDIA simultaneously gains on Chinese approvals?
It perfectly illustrates the disconnect between macro diplomacy and micro bureaucracy. When we look at these events, just impartially from the sources, we see two completely different gears turning at entirely different speeds.
Okay, how so?
Well, a summit between political leaders is about massive overarching trade architecture. But underneath that, at the operational level, the regulatory bodies responsible for approving specific hardware, they operate on their own distinct timelines.
Ah. So a macro-level diplomatic stalemate doesn't automatically freeze every single micro-level corporate application in the pipeline.
Precisely. The bureaucrats reviewing NVIDIA's H200 chips are looking at technical specifications. They aren't necessarily waiting for a handshake at a summit. And for NVIDIA, getting that specific approval means direct, immediate revenue access. The market rewards that tangible revenue, summit or no summit.
That brings up a crucial point about how this technology actually gets deployed. I mean, NVIDIA gets the approvals to sell these H200 chips, but those chips are completely useless just sitting in a warehouse, right?
Oh, interesting.
They need the physical networking infrastructure to plug into. They need the pipes to move the data. And that brings us to the plumbing of this whole AI operation, which is Cisco.
Right. Cisco is a fascinating barometer for the actual physical build-out of the AI boom.
And their numbers today were massive. Cisco delivered a huge fiscal Q3 earnings beat. The briefing notes adjusted earnings per share, or EPS, of $1.16 to $1.18, completely crushing the $1.07 consensus.
A massive beat.
Yeah. And revenue came in between $16.7 and $16.9 billion, comfortably beating the $15.82 billion expected. Let's translate that for a second. Why is earnings per share the metric we focus on here rather than just the top line revenue?
Well, revenue tells you how much money came through the front door, but EPS tells you how efficiently the company turned that into actual profit for the owners.
Right, the bottom line.
Yeah, it takes the net income, strips away some of the accounting noise, and divides it by the number of shares.
Yeah.
So when a massive legacy infrastructure company like Cisco beats their EPS estimates by that wide of a margin, it tells us that their profit engines are highly optimized right now.
It signals that the enterprise spending on AI infrastructure isn't just a conceptual hype cycle. I mean, companies are actually buying and installing the routers and switches right now.
Absolutely. The physical internet is being upgraded in real time to handle AI, and Cisco is capturing that capital.
Which leads us directly to the elephant in the room, the ultimate destination for all these chips and all this networking gear. Amazon. Our sources indicate Amazon is now positioned to become the fourth company in history to reach a $4 trillion valuation. 4 trillion, and it is being driven entirely by accelerating growth in AWS, their cloud computing division, fueled by just insatiable AI demand.
It's staggering. To put $4 trillion into perspective, that is larger than the GDP of most developed nations.
Wow.
And the mechanism driving it is scale. To train and run artificial intelligence models, you need immense, almost incomprehensible computational power. 99% of companies in the world cannot afford to build their own dedicated AI data centers.
So they have to rent the computing power from Amazon.
Exactly. Amazon Web Services is effectively the ultimate toll booth on the AI highway. Whether an AI startup succeeds or goes bankrupt, they still have to pay their AWS server bill every single month.
They're selling the pickaxes during the gold rush.
Yes, Amazon is selling the pickaxes, and the market is valuing that guaranteed revenue stream at $4 trillion.
But it's not all just a smooth, guaranteed ride upward in tech, is it? The briefing highlights a massive wildcard today, Cerebras. They are a direct competitor to NVIDIA in the AI chip space, and they made the stunning blockbuster debut on Wall Street.
They did.
It signaled just how desperate investors are to get a piece of the AI chip market. But then they fell 10% in their first full day of trading. What happened?
Cerebras is the perfect microcosm of the current market psychology. You have massive, unbridled FOMO, the fear of missing out, colliding violently with sudden reality checks.
What actually causes a 10% swing in a single day for a company that everyone seemingly wants to buy?
It's the battle between retail enthusiasm and institutional gravity. Investors rush into the debut because they are terrified of missing the next NVIDIA. That initial wave of buying creates the stunning debut.
Right.
But then the macro reality, the 6% producer inflation, the looming December rate hikes we discussed earlier, that taps the major institutional investors on the shoulder.
So they wake up.
Yeah, they look at the sky-high valuation of Cerebras, realize the broader risk environment is deteriorating, and they pull their money back out to protect it. That institutional withdrawal causes the 10% drop.
It's a brutal reminder that even in the AI sector, gravity still exists. Now, we've talked a lot about billions and trillions today. We've talked about data centers and algorithmic models. But AI servers don't buy coffee. People do.
Very true.
And right now, everyday people are getting squeezed by that 3.8% consumer inflation we started the show with. Let's bring the conversation back down to Main Street.
This is where the macroeconomic storm is actually doing its real damage. Traditional consumer and legacy companies are caught directly in the crossfire here.
So the briefing notes a major corporate contraction today. Starbucks is laying off 300 U.S. employees and shutting down regional support offices. Now, when I see a company closing a couple of underperforming retail storefronts, I just assume it's normal business trimming.
Yeah.
But shutting down regional support offices feels different. Is this a direct symptom of that inflation squeeze?
It is a profound structural symptom. When everyday prices surge, when grocery bills, rent, and gas go up, consumers immediately look for ways to protect their cash flow.
Right.
The very first thing to get cut from a tight household budget is the expensive daily discretionary item. The premium coffee is the easiest thing to just stop buying.
So foot traffic drops, and the company has to react.
But notice how they are reacting. Closing a store is cyclical trimming. Shutting down regional support offices is a structural contraction of corporate overhead. Starbucks is looking at the 6% producer inflation coming down the pipe. They are looking at a consumer base that is already exhausted, and they are taking a defensive posture.
Wow.
They are restructuring to survive a prolonged period of lower consumer spending.
It really paints a picture of two entirely different economies operating the exact same country. Because on the exact same day Starbucks is packing up regional offices, we have Ford surging 13.2%. Why? The briefing notes their new energy division is targeting $10 billion in value. Ford essentially pulled $10 billion of value out of a strategic pivot.
Well, in a high-inflation, high-interest rate environment, investors are brutally unforgiving of complacency. But they will massively reward a legacy company that proves it can adapt and unlock trapped value.
Okay, so showing initiative.
Right. Ford creating a dedicated energy division signals to the market that they aren't just sitting back defending their internal combustion engine legacy, they're aggressively building a new revenue stream for the future.
It's about showing a clear path to growth when the overall economy is shrinking. And Ford wasn't the only traditional company finding wins today. We saw S2B jump 13 to 14% after reporting Q1 revenue of $446 million and adjusted EBITDA of $72.1 million.
Huge numbers.
Yeah. And Yeti, the premium cooler company, popped 10 to 12%. Their adjusted earnings per share was 26 cents, completely crushing the 18-cent estimate, and revenue beat expectations at $380.4 million.
These earnings beats are crucial because they rely on fundamentally strong business mechanics.
Let's unpack the mechanics behind Stub for a second. The briefing mentions that adjusted EBITDA of $72.1 million. I know that's a massive financial acronym for anyone not staring at spreadsheets all day. Why is EBITDA the metric the market celebrated here?
EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Okay.
Simply put, it is a raw measure of the actual cash the core business is generating from its operations, before the accountants step in and start applying tax rules and depreciation schedules.
Got it.
In a high-interest environment, promises of future growth are basically worthless. Raw, current cash flow is the only thing investors trust right now. Stub generating $72 million in raw cash proves their core business model is highly functional today.
And what about Yeti? How does a company that sells premium, expensive coolers survive an inflation squeeze while a company selling premium coffee struggles so much?
It comes down to consumer psychology and product placement. Yeti operates in a premium lifestyle niche. Their core demographic might be slightly more insulated from the immediate shocks of a 3.8% CPI jump than the average daily coffee buyer.
That makes sense.
But more importantly, a Yeti cooler is a planned purchase. It's an investment for camping or an annual gift. A premium latte is a daily habit. When a consumer needs to save $50 a week, they cut the daily habit. They don't cancel the one big camping trip they've been planning for 6 months.
That makes perfect sense. The frequency of the purchase totally dictates how vulnerable it is to inflation. But on the flip side of these winners, the market punished the losers severely today. DOCS tanked 19 to 23%.
Ouch.
Yeah, they had an earnings miss. Q4 adjusted EPS was 26 cents versus the 28-cent consensus. And it wasn't just the past performance. Both their Q1 and full-year revenue guidance came in below expectations. And BLSH fell 8 to 9% after missing on both adjusted net income and revenue estimates.
And this ties right back to our macro discussion about the Federal Reserve and interest rates.
Because the punishment seems almost disproportionate, doesn't it? A 20% haircut for a 2-cent earnings mess?
In a zero-interest rate world, capital is virtually free. A company like DOCS might get a pass on weak guidance because investors are willing to wait for the turnaround. Right.
But today, with the cost of capital becoming painfully expensive and a potential December rate hike looming, investor patience has evaporated. If a company misses estimates and lowers its future guidance, it means their cost to borrow money just got lethal relative to their income. Investors dump the stock immediately to find safety elsewhere.
It is an incredibly brutal environment for anyone who isn't executing perfectly. And that brings us to why all of this actually matters to you, the listener.
Yeah.
Because a daily market briefing like this isn't just Wall Street jargon. It is not just abstract numbers ticking on a CNBC screen.
Mm-hmm.
It is a direct preview of the economy you're going to be living and working in for the next 12 to 18 months.
Exactly. The data we unpack today translates into very tangible physical realities for everyday life.
Right. When the Fed funds futures market prices in a rate hike for December, that means if you are planning to get a mortgage or an auto loan, or if you carry a balance on your credit card this winter, it is mathematically going to cost you more money.
Yeah. When producer inflation hits 6%, that means the prices of the basic goods on your local grocery shelves haven't even peaked yet. And when a giant like Starbucks shuts down regional offices, that is the reality of corporate layoffs hitting everyday professionals. These numbers dictate the boundaries of your financial reality.
And as we look at all these moving pieces, I'm going to leave you with one final thought to mull over. We discussed the tale of two economies today. On one hand, we have Amazon hurtling toward a $4 trillion valuation, fueled by the limitless, seemingly unstoppable promise of AI.
Right.
On the other hand, we have producer inflation hitting 6%, interest rates threatening to rise, and legacy companies laying off workers just to survive. It raises a fascinating and, frankly, quite unnerving question.
What's that?
Are we entering a new economic era where a handful of mega-cap tech companies become entirely detached from the macroeconomic gravity that governs the rest of the world?
Yeah.
I mean, can Amazon, Cisco, and NVDA live in the clouds forever while Main Street drowns in the storm below?
Man, that is a brilliant and slightly terrifying thread to pull on. The barometer says it is perfectly sunny for big tech, but the hurricane is absolutely battering the rest of the neighborhood. Well, that's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.